And Sushil Choksey is here with us. Sushil, when the management says that $2 per barrel is what we've gained from hedging and inventory, is that a standard thing? Does it happen every quarter, or does one have to then adjust that GRM and say, okay, the real GRM, comparable GRM is 9.5?
Good morning. Thanks for having me on the show. Just taking a question from your point. You know, crude inventory which you carry, the quarter on quarter, the crude prices moved from $28, $30 to approximately $45. Yeah. So the differential which you arrive on the crude inventory which you have gained is roughly around 1100, 1200 crores, which is estimated in current quarter for the refinery business. That's a going estimate because there is no inventory data available with, other than the balance sheet when you receive. Reliance has not released March 16 balance sheet so far. Once you have that in hand, you will come to know the actual figure.
So basically it is quarter on quarter crude inventory which is being the difference between the price at which you bought it or long-term contracts that you had, and you adjust it and you mark to market prices, is it? Or
that's right. So basically what you bought and sold plus the closing inventory on March to current quarter closure would have given a gain compared to the previous quarter. In the inventory plus sales gain, that would be added to the GRM on a normalized basis.
So is the inventory mark to market on the 31st of June? How is it done?
Every quarter you will have to have a opening stock and closing stock. So that's part of a function in any business. So it's nothing only Reliance has to face, but it is everybody who gets the benefit of it. Benefits or loss, either side. If let's assume the next quarter the crude is down, on an average basis, Reliance will have to mark that too. So it is part and parcel that I think it's an ongoing process for any 365-day working industry, that your throughput or raw materials have to be accounted in that fashion. So if you knew crude had gone up, I think the market analyst knew that crude has moved from the lower range to a mid nearing 50. So Reliance had to gain somewhere.
That's the question that I wanted to ask you. That if the anyone who's working out those Excel sheets and Reliance is heavily tracked company. It's not as if it's tracked once in a lifetime and then you put out a report. It's tracked almost every day, I guess. Shouldn't analysts have assumed that this kind of crude grain inventory gains will take place and therefore the GRM will turn out to be higher? Or did they actually assume that and Reliance beat that by having a core GRM higher than what they expected?
I think analysts have too focused on what Singapore GRMs are looking at quarter on quarter or annualized basis, and then they put a certain amount of premium for Reliance products based on various cracks the way it happens. I think we need to move away from analyst forecast and look at what Mukesh Ambani wants to forecast for the shareholders and what is predictable for future. So going on quarter for Reliance for last 5 years is fine because they were in an investment phase. I think now is the phase if he surprises, rather Reliance Industries surprises with all the efforts to expand India's capacity, thinking of future, or putting in a lot of money for businesses which have not generated revenue. So how they shape up in the next 18 months to showcase that India's demand is going to rise and the productivity is going to rise, and both will lead to a betterment. I think Reliance Refinery at $10, $11 is a very stable business. They're able to source multiple different kind of crude in excess of 125 different supply zones, various types of Arab heavy to light and distillates, Venezuelan crude, they have got even sourced African crude. So in view of all these efficiencies and processing almost 2% plus crude of the world at a single location, now the product mix of 59% which is exported and 41 domestic as the presentation indicates. As India's demand and their own fuel stations open up, whether it becomes 50-50, how their margins look once they open up into Indian markets, that needs to be watched out. I think the investment phase of Reliance is over, and with Jio launch around the corner, whether it happens in 2 months or it happens on 28th December as usual every year, time they start something new, that we need to watch out. But I'm quite sure that going forward, next 18 months is one of the best exciting phase of Reliance Industries shareholders.
Very interesting, because Jio, your views on Jio, because the question of course is that now we are hearing that it will be about 1500 billion odd in terms of 60,000 crores is probably what Reliance is putting into capex. It's upped it by 15,000 crores, and the debt equity earlier was I think 1:2. Now that's going to go down a little bit. 2:1. That's going to go down a little bit, and we are hearing that it's going to be more than 1,500 billion, which is 1,50,000 odd crore. My question is, this kind of investment in a market which is seeing price being beaten down, how long is the gestation period? How long does it take for you to start making money here?
I think the investment phase of Reliance Jio, first year would be to garner or capture customer base, get the customer feel. So once the addiction happens and the data usage increases, they will be able to have a pricing power based on what kind of efficiency the product LTE is likely to achieve with the consumer. So, don't assume that Jio is going to give any profit in the first year of operation. I think first year would be going to 5 million, 10 million, 15 million, 20 million customer quarter on quarter. That is need to watch out, unless they have an arrangement with Reliance Communication to share their business model with their consumer base, which is existing on the other side. I think it's going to be more a viewpoint with what kind of customer base they attract over a period of next 1 year once they commercially launch. And that is more important, because I think initial penetration will happen with a lower price, as what they've done with handsets already. So I think one should not assume that they're going to have a big revenue or a profitability out of Jio.
How will it be valued, that business be valued over a period of in the next 1 year at least? Because is it going to be similar to the way in which these big e-commerce companies are valued, or let's say a Facebook is valued? They're on the basis of customer base.
I don't think so. I have a expert opinion on telecom, but knowing the current market, I think people will start seeing what is the usage, that is ARPU per customer, where Reliance Jio customers are concerned, compared to Bharti and Idea or any other telecom operators achieving. Based on experience, if this digital play of Reliance is able to convince customers to use on more basis, and if that signals a positivity, people will look at incremental growth quarter on quarter and visualize what will happen few years later. Right now, it's all core business money which is being earned out of Reliance, which is being put into Jio, with a thinking process that in next 2 years, core business will have sufficient cash to neutralize the negative impact of Jio. And by that time, Jio will have to stabilize to support the entire balance sheet.
Right. Sushil, you also track LIC, and we've spoken about it earlier that you like that name, you're positive on that name. If one would look at the previous quarter, probably one NBFC that has not done well is LIC Housing. Considering the numbers that they have delivered, they are decently cheap?
I think going by the yardstick, I think price to book is the best way to look at any housing finance or a bank or a NBFC. Looking at that, at trading below 2.5 seems attractive. They had one-off because of some real estate financing which they've done to a specific developer, where they've taken a charge. And there seems to be a question which you asked about some employee charge in this quarter, which seems a bonus which they've paid out for the previous year. So if even out that numbers, I think the numbers look good. But 2.2, 2.3 times book on an estimated current day basis, I think seems a steal if you take forward, because margins on most of the NBFCs and housing finance companies are likely to expand. Plus, affordable housing and a lower end of the housing market is likely to have a much better growth based on current monsoon pattern which is visible. So if growth gets back to India, I think next 2-3 years would be exciting time continues, because keep in mind, most of the new entrants in housing finance companies or NBFCs are able to attract 4 times, 3.5 times book value, where private equity and shareholders are investing.
Even compare with Canfin Homes, which also came out with numbers, that I think is 3.2, 3.5 times book to book. And
Canfin is much more illiquid compared to LIC Housing, so liquidity is also a driver of a price. So looking at LIC after HDFC seems to be one of the best brands in the marketplace. And LIC, keep in mind, has huge base to attract resources, which is a key input to LIC Housing. So be it masala bond or NCD or commercial paper or taking money from National Housing Finance Company, I think they would be one of the best candidates to perform well.
Right, Sushil, thank you so much for joining us. Pleasure talking to you as well.